back to the real effects. I'm just going to be talking today a little bit about trading psychology and my journey. So I have been trading for almost 4 years, I would say, on the same strategy for the last 3. So what I've learned is there's a lot of ego in play for the first couple of years. So you will be influenced by other people, you'll be influenced by all sorts of stuff, either on social media, mentors, trades that you miss or potentially papered, and then you incorporate that into your trading plan, and then it doesn't work the second time, and then it works the third time, so you keep it in, and then it loses 10 times, and things like this. So it's about learning what time frame you work best on. It's about working with a specific model and a specific time frame and strategy as well. So there's a few things that you can do. I personally use a little bit of SMC along with just high time frame narrative, basically. So I'll look on the weekly perspective, go down to the daily, and then set alerts based off that, and usually follow the 4-hour order flow as well. I'll look at counters sometimes, especially if it's broken structure and it's looking like a pullback. And sometimes I'll trade a supply or demand interaction point where I look at expectation order flow for it to go up or down. I'll use that as a reaction point and just catch the opposite when obviously other people are getting in the market on the other direction due to certain confluences in the market. So I'd say the simpler trades, the ones that are really easy, are the better ones. So something I wanted to break down is for the last year up until recently, my actual trading ability has been completely fine. Most of the trades that I've documented that I didn't take on live were very simple, and they worked pretty much every time. So the ones that I did take had such levels of complexity to them. I thought that was the only way I was able to make money, as if it was hard and it was complicated and it was against the market, and this could work, but I'm going to do the opposite, or I'm going to wait for this really complex setup. So it's just about simplicity and about emotional control, and I try to use fixed stop losses and fixed risk rewards. I'll usually take things from an hourly perspective, or maybe even a 4-hour, and sometimes I'll go on a 15-minute if there's a really clear setup and there's a refined zone within a daily or a 4-hour, and you're mitigating some liquidity and sweeping everyone out, and it's an aggressive pull from that position. That's completely fine. So yeah, I just wanted to go across some of the psychological motivations that I've had recently, which has changed my strategy in terms of what I look at, how the market's broke me down to the point where I just almost don't care anymore whether it wins or loses. I don't care if the trade does more than 3-4 hour. If it goes up 10 hour, I'll still take profit. So it's just about managing risk. This isn't gambling, this is strategizing, risk management, and containing profits and losses at the same time.
So I just want to run through a few tools that I use to trade. This being the main one. So this is the GAN box that I use for the 50% of pretty much anywhere in premium or discount. So everywhere the top end of this leg is in premium, anywhere in the bottom is discount. So when you're looking at trades, you would like to assume that if it is going up in this direction here, when it reaches this level of the equilibrium of this leg, it means it's likely to continue up. And when it gets lower, it is likely to create the swing low, and that is a high probable swing low, providing we're in bullish order flow. And then you can get involved anywhere around here and ride it up to either the next high, which is here, or simply get involved in a few 1 to 3s. It depends where your stop loss is, but obviously if you've got, say, a 60 pipper here, you'll be riding a pretty much 7.5R, whereas if you get a nice 3, that goes to the equilibrium, which is quite a safe bet, because alternatively from here it can come back up to the equilibrium in premium on this leg, use this as a demand interaction point, and then fail, and at least you've contained profits in that particular circumstance as well, because obviously sometimes you don't know where the market is actually going. But say if you look at it in context here, so this is on GN, so we have got a nice pull all the way up, it comes back into the equilibrium. So if you were to draw it as well, you have this nice sort of discount area here. It's mitigating just the fair value gap. It hasn't actually come down to this area. What a nice play would be on here is that to be swept and it come into this area and play off. But obviously we look here at potential buy, even from this area here, because it's reacted. It's kind of wicked out a few times, and we could look to get involved to the next swing high as well. So the next one I want to show you is just the boxes. So these are for supply demand boxes. You can use them as refined zones as well. So you can put a refined lower time frame zone inside, and sometimes the market likes to use this area as an inducement, and it comes up, creates some early sellers, sweep up, do an aggressive shift, and go down like so. So that would be all the buy side liquidity swept, and then anyone looking to get involved here would be taken out. They're always wondering, why did it snipe my stop loss and everything? So it's because the market has provided you with liquidity, and you are the liquidity. So this is the next one. This is a buy side liquidity pull, and the same on the sell side. So we can see if we can find one there. Perfect. So this is a pool of liquidity which looks to be swept. So these sellers here are all getting swept out. And the next one is the arrow that I've been using all the time, just to create paths, which sometimes makes you understand where the market's going and what you're looking to obtain, so you don't forget what you're looking for price to do before you enter. And these are the last two pretty much tools that I use, is the inducement tool and the liquidity sweep tool. So the inducement tool, as we were saying earlier, is something where the market is induced and early buyers or sellers get involved, which, even though it works off here, this is inducement into this order. So you could use this as a tool, and let's find a liquidity sweep as well right here. So this substructural low has been swept by a wick, so anyone involved in the market at that point is going to get swept out by a wick, and that is a potential sign for a continuation as well. And we have entered some sort of equilibrium. We've had a reaction from the supply and a continuation throughout the leg, which has also created a lot of liquidity on the shorts here as well. So anyone looking to get involved in shorts, all these sellers in play will get taken out as well. So I've got a few others on there you may have noticed. So I like to use, I don't really use it anymore, but there's the chalk bottom, so that's the change of character. Let's use it properly anyway. So we got a shift here. Would that be a shift below? Let's have a look. No, yeah, so that is the shift. So we got the sweep of the lows, followed by, so that would be sweep of the highs here. So you don't have to use the swing high from this area, even though it is obviously better. But as you see in this circumstance, the swing high versus the substructure, you could have got involved in one of the very early plays of this buy position right at the bottom, and that would be valid, because it's created a low, high, low, and then it swept this substructure. So that is valid for a change of character, even though we would like to ideally see the sweep of the highs from this pullback for a higher probable play. But this is more of an aggressive change of character in this particular circumstance, because it has come down, pulled back up, and then that is a high being taken. So essentially what it does is it sweeps the lows So it takes out any liquidity of the lows. It induces more sellers into the market. So it's broke structure. It's taking the low. You've got some more sellers in play here, and then these get taken out, and then it comes back down as well, and more people get involved, and then that's when the buyers come in. So obviously, if you're looking at anything in what would you say, this area, you can look at reaction, as I was saying earlier. So there's a supply interaction point. It's wicked the high. It's come back and it's tested the sell to buy wick. So essentially what we've got is a quick wick out. Sometimes you can look at it as a liquidity sweep and a continuation, but from here we're looking at this being in the equilibrium of the leg. We've got the change of character, we've got a failure. Normally it comes back lower, but we've got this nice area below. This would be a much higher probable play from this extreme, but we've also got a wick here. So these two areas would be better because they're in discount and it has wicked, so it could come back lower. But if we're looking at a play from the daily and we're looking at just a continuation with aggressive play, we could look to get involved there. So I'm just looking really easily at how you can trade just continuations of order flow and pro trend, because counters tend to catch you out quite a bit. So we're looking here without much context. It's pretty bullish, and without looking at it, you can go in the bar replay and you can just play balls up until a point of where the market wants to reverse. But in this area, you have a lot of opportunities to get involved in buys. So there's a sweep of this low, potentially get involved somewhere around here. I would not be trading that much, but I don't want to take the position down. There's a wick high, which could create discretion in potentially counters, but then again, very simply, just placing the orders down here and just buying. It's just quite easy. This is in discount basically, so anything in discount, that's broke structure. So we have a break of the candle body from the previous swing high, and anywhere in discount, that's all I'm looking at. So this leg, that enters discount. We've got a nice daily sweep of liquidity here as well, where it's wicked the low, and obviously it's failed to break a high, but it's wicked the highs as well, and it's come back down into this order and very simply just took off. And what you'll find is a lot of people get involved in these entries and see how it came back in. So it tested the highs, which became range bound, so you would have broken even. Alternatively, if you got involved in the 4 hour, maybe you waited for this initial mitigation, that would be a 4 hour shift somewhere around here, and you could get involved in this doji wick. And then following that, we finally have our break around here. So that's where the candle body decided to close. I don't really trade breakouts like this. I can trade the reaction points. So I mean, it wicked here. You could have got involved somewhere around here as well. And what the main principle of the psychology is, if you were to continue doing buys and you weren't predicting the reversals all the time, then even though this one lost, you would still have 3 winners and 1 loss. So, you're 75% accurate across all the trades. Whereas if you tried to predict counters, you would have lost this one, you would have lost this one, you would have lost this one, and then won this one. So it'd be the complete opposite. So you might as well trade with order flow every time. So here I'd like to talk about risk reward. These are the basic risk rewards I use with the stop losses as well. So you can look at this. I use 30 pip and 60 pip stop loss almost every time. With a 15-minute, I will go a bit more aggressive. But usually my targets with the 1 hour are 30s, any 4 hours 60, but the risk reward is always the same. I wouldn't be looking at a 60 pip as a 1 to 10, or probably even a 1 to 5. So we've got a 1 to 3 and a 1 to 2 here. These are the main two. These are the highest probable. So when you're looking at pro order flow, you're looking at discount trades, most likely you'll find these work most of the time, more than 50%, which means you'll be consistent and you'll be profitable, which is what you want to aim for to start with. You don't want to be looking at these, because these are a lot of understanding on where the swing and the high time frame is. You have to understand the pair, what it's swept, and all the time the market's going up here, and you're in profit, you're in profit, you're in profit. If you don't split risk or you don't take profit and it goes to here, you've just lost out on all of those gains. So the amount of times this happens and the amount of times it actually hits here, if you're just going for 1 to 10s, you're going to take 9 losses and 1 win, and you're just going to break even every time. So just be careful when looking at them, especially if you're starting. I would be looking at even 1 to 2s just to begin with. If you can get a 1 to 2 out of the market and you can be 80% profitable, you are laughing, you're fine. And even with 1 to 3s, this is my favorite. A 1 to 3, even on the 1 hourly, you can do that within the day on the 1 hour. You don't have to wait any longer. People think, oh, it's not intraday trading if you're trading 1 hour, where it is. You can achieve profit within that time. That's 90 pips from a 30 pip stop. Yeah, the market does move that much in one day. Depends what pair you're on. 1 to 2 days, especially with the 1 hour or even the 50-minute, sometimes you've got 150 pips, which if it's going in the right direction may take up to 2 days. Especially I know on EU, it can be quite a slow pair, but something like GU, a bit more volatile, may complete that within the hour. So it's all using the same stop losses. I find if you can't cover the stop or the swing high with the stop loss, look lower, look at a lower time frame, or look at a different entry, because if the order is really big and you're trying to cover a massive stop like this, just either split it in half, because sometimes it likes to come for the halfway point, or look at a refined zone in the extreme areas on a lower time frame and just set your order. You don't even have to wait for the confirmation if you really don't want to. If you're on an hourly setup, you've got this nice one here, and it's done the changes and everything, or this is the order that you've come from. So say you've got your hourly confirmation from a 4 hour, and that 4 hour comes from a daily. You can place your order like this, and may not tag it, but that's where fear of missing out comes in. So it will come up here, and you'll be inclined to get involved as it reacts. It will come up, wick all the liquidity of the previous people, and come back down. So anyone who's in a fear of missing out trade because it's hit here, it will come down. Everyone will have their stop losses, go down, 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 probably around here. That will get wicked out and you'll get tagged in. So that's simply how it works sometimes. Not always, and you'll find you'll miss the trade sometimes more than others, but you have to learn not to care, because at the end of the day, the markets are there to take people out who are using emotion. But a 1 to 5 is good, especially on the 15-minute, if ever I'm getting involved in a 15-minute trade. So even from a 1 hour perspective, you can look at it. Say you've got your 1 hour change of character and you've got a reduced risk confirmation break of structure. You just want to wait because it's mitigated an equilibrium, and you think, oh, there's a bit of discrepancies whether or not that's going to go up or down. If you see from here, there's a nice 15-minute shift. Let's say it swept Asia. It's manipulated some sellers here, it's swept some liquidity, and you've got a nice 15-minute short, and it goes with the narrative of the order flow. So providing the order flow is bearish, goes in that direction, you should be okay to get a 15-minute entry from the 1 hour, especially when the 1 hour, say you come here, you're trying to cover it and it's 100 pips or 60 pips or something crazy because it's a massive order. I know it says 20 there, but say that's like a 5x. You just want to get involved in a bit more refinement. But especially if you're starting, I would look at just doing hourly basically every time.
Yeah, I'd say one of the key takeaways in the trading that I've realised recently is a lot of people will take multiple trades a week. They'll do low time frame trades. They'll have multiple trades on at the same time. They'll be scalping. They'll be doing all sorts of stuff. But what I've come to realise, it may be different for other people, but the amount of losses and wins you take, and the amount of 10Rs you do to the amount of losses you do trying to get that 10R, or even on a 1 to 2, if you're taking multiple 1 to 2s a day, you're not doing clean, high probable setups, so you are going to lose quite a few of those. Even if you lose 50% and you just break even, what is the point? So what I've come to realise is I'd rather look at some really nice swing trades which have like a 5 or 10R, from just a very patient perspective of looking at order flow, waiting, and even doing those once or twice a month, because if you can get a 5 or 10R, that's that's 120% as a max every year, which is good. And if you're scalping, you're still looking for the same targets, you're still looking for the 10%. And if you're doing 1 to 2s, 1 to 3s, sitting there on the charts all day, you go through a lot of emotional stress and you look at stuff that isn't there. You change your plan. When you look at the charts, you're looking and you're making confluences in your head. So if the alerts aren't set and you haven't waited for that emotionless position to be mitigated, you will create confluences in your head, and the market will show you confluences, and it will show you the neutral on both sides confluences as well. And so you have to be very strict on what you look at and how you perceive the market, where you set your alerts, what time frames you're looking at. Is it following order flow? Is it countering order flow? Does it make sense, and is it simple? Because if it's very complicated, most of the time it doesn't work. I don't know how many times, probably less than 10% of the time, I'm having to really think about a trade. Yeah, it actually works. Most of the time it works when it's just like, oh, that's easy. Oh, it's just slap a position, boom, done. So you just have to look at the markets in a very simple way, and that's why it's so hard, because you think it should be complicated, but it's not. It's quite simple. But it's just all about a mental game rather than knowledge based, because you can backtest the markets. I can backtest the markets and make money every single month, any pair, without fail, every time, without knowing where the market is. So you can cut it off and you can just play it forwards because it's emotionless. But as soon as it comes to live, different story. So you have to really think about that when you are backtesting the market. It shouldn't give you a false sense of confidence, because psychology is 90% of that as well.